Chapter 1. Why Investing is Easier for You Than Warren Buffett. Warren Buffett is the world's greatest investor. He began his investment career at the age of 11, buying $114 worth of stock. 73 years later, his net worth is almost $70 billion. How did he do it? And more importantly, what can we learn from Buffett's investment strategy that we can use to make money for ourselves? There are many things that Buffett does that you and I will never be able to imitate. You and I will never purchase an insurance company and invest the float. You and I will never get a phone call from Goldman Sachs offering preferred shares with a 10% dividend yield. On the other hand, the individual investor has many advantages over Buffett. Buffett is currently sitting on over $50 billion in cash that he needs to put to work. Because of the size of his cash pile, Buffett is limited to investing in only the largest companies. And when he buys a stock, he needs to move slowly to avoid moving the market. You and I can quickly buy almost any stock, without rumors swirling and moving the price of the stock. We can buy stock in a company of any size, from a micro cap to a mega cap. We can buy the kinds of smaller, faster-growing companies that Buffett was able to buy in his early investing days, but no longer. And we can sell our shares if and when we choose. In 1999, Buffett wanted to sell his shares of Coke, which were sporting a lofty average PE of 47. He was unable to sell for two reasons. One, he was on the board of directors at Coke. Two, his position was too large to be able to make a graceful exit. You and I will never have these constraints. We're free to learn from the best of Buffett's investment insights while operating under the radar. I have studied Warren Buffett and his investments for over 20 years, and I've read all of his annual Berkshire letters. Over time, I've tried to distill Buffett's most valuable investing insights. If I had to summarize Buffett's main investment strategy in one sentence, it would be this: buy shares in a few high-quality, well-run businesses at a fair price, and then hold them forever. Buffett has been preaching and teaching this investment philosophy for the last 40 years. The secret is hidden in plain view, and yet so few investors have put it into practice, even while they have watched Buffett's wealth compound year after year. The strategy seems too simple to actually work. Yet, as Buffett reminds us, there seems to be some perverse human characteristic that likes to make easy things difficult. And elsewhere, I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. In this book, you'll learn how to find those 1-foot bars so that you can step over them too. It is not as exciting as jumping over 7-foot bars, but I hope that you will find it even more financially rewarding. To implement Buffett's investment strategy, you must first learn how to spot a high-quality business, which we'll cover in chapters 2, 3, and 4. Next, in Chapter 5, you'll learn how much you should pay for a stock. And finally, in Chapter 6, you'll learn about some of the best times to buy stocks. Before we move on, it's important to remember that, for Buffett, stocks are not just pieces of paper or wiggles on a stock chart. Rather, they are ownership interests in real-world businesses that entitle you to a share of the present and future profits of those businesses. When you purchase a stock, you become a part owner in that business. After you purchase a stock, it may move up or it may move sharply down. Your ownership and your share of the profits and dividends remain no matter what happens to the stock price. If the business continues to do well over time, and provided that you paid a reasonable price for your shares, you will make money. It is now time to learn what constitutes a high-quality business.